Recently, Vanguard has been in the news for their announcement that they are going to be cutting fees on their funds once again. Now, while this is great news, I'm going to show you another piece of information put out by Vanguard that could add 100 times the value in your portfolio. Now, 100 times is a huge number, so how could that possibly be the case? In today's video, we are going to dig in. So when you look at the fee cuts in Vanguard's funds, this is a snapshot. Now, they cut fees across the board, across all their funds. I just wanted to give you a quick glimpse. So this here is going to show you some of the fee breaks from some of the different funds that might look familiar, right? Your big S&P 500 fund, right? Whether it's growth, whether it's value, you have your midcap, you have your 3000. So you have all these different indices, and across the board, you'll see fund fees coming down. And those fund fees are going to come anywhere from up here where you can see a 0.01% drop, and then right below it, you see a 0.03% drop. So across the board, Vanguard is cutting fees. Of course, that is great news. How are we going to provide more value than cutting fees? Well, let's talk about something that Vanguard put out in January that talked about the 10-year capital market assumptions, or what Vanguard is anticipating for market returns across asset classes. Now, I did a video of this recently, and I update this pretty frequently, but this report here is a snapshot from Vanguard that looks at, okay, across the board, whether we're talking about US stocks all the way to REITs, which is real estate investment trusts, and everything in between, based on the current valuations, what are the expected rates of returns in these asset classes? And you can really dig into Vanguard's research if you want to, but essentially there are some asset classes that are really expensive, therefore they're anticipating a lower rate of return based on history. And there are some asset classes that are relatively inexpensive, which history tells them that you're going to see a higher rate of return. And what do we see here? We see that up at the top, you have your broad U.S. equities earning you between, let's call it 3 and 5%. And this median volatility, that just means how much variability is in your returns year to year. Because you are in the market, it goes up and down. But let's focus on this return projection. These are annualized numbers for 10 years. And so, okay, let's go back to that 100 times the value piece. Well, what I would argue, let's get rid of this chart for a second. And what I would argue for you to shift your focus is not on the fact that Vanguard cut fees. Of course, that's great, because any fee in the absence of value is just taking money out of your pocket. But now that that's done, where can we shift our focus to actually drive potential returns in your portfolio? And that's looking at this piece of news here, which is based on current pricing, what are the long-term expectations for different asset classes? Because for most, a simple, air quote, balanced portfolio is something like the S&P 500 and some bonds. And I know that is oversimplifying. There are other allocations. However, as we go back to this chart, what we can see is just U.S. equities being between 3 and 5% is probably not what you're expecting in your portfolio. If you're investing in stocks, you're probably expecting higher. But let's dig in even further and go down and break apart this 3 to 5%. What you see is you have your U.S. value, you have your growth, and then you have large and small companies. And if while you have a blend of 3 to 5, it's comprised of all these kind of put together. And what is the lowest expected rate of return? It's U.S. growth, which is like the S&P 500, like the NASDAQ, these very expensive indexes that have done very well in the past. But the higher the price goes, the lower the future expected rate of return, all else being equal. We've talked about this in a lot of videos. And so where does that leave us? It leaves us with U.S. growth of between 0 and 2% expected rate of return for the next 10 years. And then as you move towards value, you can get a higher rate of return. Smaller companies give you a higher rate of return. But typically, a blended index portfolio doesn't give you much allocation to smaller companies and doesn't really move you into value. You have to do these actively. You have to make an active choice. And then we can obviously move to global. So you have, these are international, developed, emerging markets, all giving you a higher rate of return than potential U.S. equities, in particular U.S. growth. And so what's the 100 times number that I was talking about? Well, if you can save 0.02% on your fund, of course that's great. But where's the real driver of your return? Because if you have $1 million and you save 0.02% for 10 years, you're going to save about $2,000 total, so about $200 a year, okay? Versus if you can get a 2% higher rate of return on your $1 million for that same 10 years, you're going to have $200,000 more, right, over that same time period. because 2% is 100 times the value of 0.02. And what I would argue is maybe just look at this chart and determine, is your portfolio allocated in the right way? Or are you looking backwards and saying, what's done well in the past, that's what I really like? Look forward. Pay attention to these numbers that Vanguard's giving you because it's really simple. Expensive things have a lower expected rate of return. Cheaper investments have a higher expected rate of return. And right now, for many people, they're in this large cap growth index or ETF or fund that Vanguard just lowers their fees on. However, if you get a very low fee on something that returns you almost nothing over the next 10 years, you're probably still not where you want to be. You're not on track to reach your goals. And so 100 times the return, that's going from, hey, if you say 0.02 to 2%, as you can see, the difference between growth and all of these other options is way more than 2%. And so it's actually more than 100 times more important that you look at where is my money invested, if it's at Vanguard or if it's wherever, whether you're paying 0.05 or 0.5, the real delta, the real difference is going to be where am I allocated around the world? Is it in asset classes that are going to give me or that are expected to give me the rate of return that's going to keep me on track for my plan? I hope you found this helpful. And as always, thanks for investing your time with the Personal CFO.